30, 40 years from now, it probably won't be private markets. It'll all be one thing because technology will have torn down sort of all of the barriers. The barriers are mostly information barriers, right? If you have like perfect information and transaction costs are near zero, then essentially what's the difference between public and private markets?
Hello, fellow data nerds. My guest today is Ben Miller. Ben is the co-founder and CEO of Fundrise, an online real estate investment platform. They manage over $7 billion in real estate and have over 2 million investors on the platform. And they recently launched a new initiative to democratize investing in venture capital. Ben, welcome to World of DAS.
Hey, Auren, how are you?
I'm very excited. Now, Fundrise democratizes investments in real estate and other assets that are usually kind of closed off to like the average retail investor. And in some ways, your business is part of like the general vanguardization where more businesses are offering index and kind of retail friendly investment products. What are your thoughts on like that trend overall?
Oh, the arc of history bends to democracy, Auren.
I love it. Okay.
Yeah. I mean, if you think about it in a much longer, like go look at it over hundreds of years.
Yeah.
It's been a steady progress towards democracy. You go back to, 1600s, pretty much all companies you were the company. The person was the company.
But wait, weren't we in the 1600s, weren't we all investing in tulips back then and stuff?
That was a very small number of people, actually. But, there was if your company owed money, you owed money personally. Yep. There was no separation between the company and the person. And the joint stock company created that separation. And then from there, right, more and more people could invest in it. And it's been, again, a steady transition to democracy. So like in the 1900s, like if you were 1900 and you wanted to invest in AT&T and Coca-Cola, it was just about the same process to invest in OpenAI or SpaceX now, right? You have to have an introduction, you have to have access. And then the funny thing about it is that technology and democratization have always gone hand in hand because, for example, most people didn't own stocks. The mutual fund was invented, Vanguard gets invented, online trading gets invented. And every time those inventions happen, more people have access and the cost goes down, the cost of intermediation, right? The fees and the spreads in trading, all
Yep.
of that has shrunk over time to the point where public markets, right? You can't really beat the market, right? Vanguard beats any hedge fund. And so that same thing's happening in private markets, the exact same process, the exact same trend. And they're basically converging. Public and private markets are converging.
One of my favorite books, I don't know if you've ever read it, it's called A Piece of the Action. Have you ever read this book?
Mm-mm.
It's like the history of Merrill Lynch, Charles Schwab, Visa, Fidelity, and a couple of the other ones that kind of like really helped democratize in that era of new investors.
Yeah. You see comes in waves, usually because of some kind of technology. So like Schwab, it was transitioned from like telephones to like a different model. So
yep.
It's technology is like integral to this, and so that's what our platform is, a technology platform, but it also it's sort of private markets have some very high quality investments, so it doesn't make sense that it should be barred off to normal people, in my view. So.
Now, there's been this idea of a REIT for a long time, which essentially allows like the average investor to invest in real estate assets. How do you think of yourself, your kind of core fund, in relationship to like a REIT?
Yeah, well, so a REIT is a tax designation technically, and so it lets the entity be tax free at the corporate level.
Yeah,
and it's meant to. Democratize investing into real estate. Public REITs are pretty established, and I think pretty good investments, and that just leaves out the majority of real estate, which is private. And so the problem with public assets is that there's a small percentage of the market, small percentage of real estate, and sometimes the private markets are much better priced, and sometimes the public markets are better priced. And so really, what you want to be doing as an investor is you want to be crossover investor. You want to go where the prices are lowest, and that structural kind of like uh, flexibility to move between public and private, that's let's say a big part of the sort of alpha you can generate. You see that in tech. There are crossover investors in tech, but we're the only crossover investor. Maybe I guess Blackstone does it, but it's very rare to see crossover investing in real estate.
And beside fundraising real estate, like what other companies do you look at as models that are kind of democratizing these asset classes?
Well, so I mean,
like AngelList or something, or
our model, and I also think of my biggest competitor threat is Blackstone.
Yeah.
So Blackstone started something called a B REIT. The B REIT is it's a REIT that anybody can invest in who has there's some minimum net worth, and you have to go through intermediate channels like your broker dealers, and there's sort of like some higher fees, but they I think the B REIT is something like $75 billion. They launched it in 2017, so it's about the same size as Sequoia.
Yeah.
So that's been a really interesting model for us because there's a lot of similarities, and then there's differences because our model's direct, our model's lower fee, and then our model's more technology. Others, I mean, the best technology has been to sort of, let me say that again. I mean, the best models have been in the public markets so far, right? Vanguard, Schwab, exactly what you said. The beginning of this opening of private markets started about the same time as we started, early 2010s, and it's a multi-decade long process. It'll be 30, 40 years from now, it probably won't be private markets. It'll all be one thing because technology will have torn down sort of all of the barriers. The barriers are mostly information barriers, right? If you have like perfect information and transaction costs are near zero, then essentially what's the difference between public and private markets? It doesn't exist.
Now, Vanguard is an index. They're not actively managed. They kind of buy everything in an index, and you know what you're getting. In your funds, in some ways, there is like a manager in a way, like you're buying certain assets and you're deciding what to buy and what not to buy. Yet you kind of like charge in a way like an index fund. Like, how do you think about like that? Because it takes a lot of work to actively manage something.
If you're enjoying this podcast, please sign up for our newsletter. Go to worldofdas.com. The link is in the description below. Now back to the video.
Yeah, I wish we could be an index fund. The private markets are just so inefficient, and there's still a lot of work to be done. Like, somebody actually has to do the work of buying the building and repairing the buildings and managing tenants. I mean, there's a lot more work than just like a wrapper index.
Yeah, and typically, like if you invest in like a real estate person, like they're going to take some carry because it's a lot of work on the deal. Like, from the best of my knowledge, like Fundrise does not take a carry.
Yeah, so the 20% carry, I think there's two reasons why we didn't. One is I came out of the 2008 financial crisis feeling like the carry was like a one-way option. So like everybody got paid to take risk.
Yep.
But nobody paid anything back when they lost from the risk. Yep. And you saw that really with financial assets most of all. And then the vehicles we chose the regulatory vehicle we chose to create with the SEC or working through the SEC, the SEC doesn't allow funds to take a carry if retail investors are invested. Like, they feel like retail investors shouldn't pay a carry.
Right. So this is the main reason why most of these funds don't allow retail investors is because they want to charge a carry, essentially.
Yes. It's funny. It's actually one of those regs is not on the books. It's like a reg. The SEC has some regulations that they do by sort of like not qualifying you unless you agree not to have a carry. So this is one of those. And so probably, at some point I can imagine that breaks down, and because it's like either they have to make it a regulation or eventually people will start doing it. But I felt like it was a competitive advantage. Ultimately, Vanguard wins because of the lower cost structure.
Yeah.
And so, the model is more like an internet company, like Amazon or Costco, right? They want to have the lowest cost structure, and they win by being the lowest cost solution. And so it's a little bit like because we could have charged carries on some of our earlier funds and some of our funds, but by and large, I think it's short-term pain. But if we can build a model that uses software instead of people, if we can deliver comparable gross returns as private investors and better net returns, then we have a much better product.
Yep. And in some ways, you guys were one of the first companies to take advantage of these regulatory changes that made crowdfunding investments easier. Is there some sort of like next regulatory frontier that you're looking at now?
Yeah, it's funny. We started before all of that, and then we definitely took advantage of some of the regulatory changes. What I think happens is that private markets are going to start getting regulated like public markets. You've seen some proposals come out of the SEC where they want the private markets to start to produce audits and start to produce more reporting.
Yep.
And as that happens, again, like that information asymmetry will really continue to shrink. And so it's like, so it's more like if the private markets have to deal with the realities of the same basically challenges we have to have because we are already acting like a public investor. I mean, we're registered. All of our funds are registered. If the private markets end up having that same regulatory burden and no software, it's more about how we can create sort of a competitive solution, because it's a lot of the narrative in private markets is that they have exclusive deal flow and exclusive access to data.
Yep.
And my experience is that's not true. I mean, maybe Sequoia does, but like the other 4,000 venture investors or like 50,000 real estate investors like have no asymmetry in their advantage over the other private managers. But they take a huge amount of fees and carry. I mean, half the returns.
But also for most of these, we know that most of these funds are net negative in their IRR.
Well, venture is a little different than most of private markets. If you the venture is like a small part of private markets, right? Private markets are like 20 trillion, ventures maybe 1 trillion. Most of it is like real estate and private credit.
Yep.
And those
can do well.
Those have sort of much less dispersion in outcomes. Like they're tightly coupled. Like there's very little alpha difference between like the average real estate fund and the top quintile.
Oh,
Ventures, really? Yeah, it's very little. And same with private credit. That. Yeah, there's like it's almost the opposite of venture.
So it's really just based on the economy and stuff and vintage.
Yeah, it's much more a beta play.
Yeah.
So it's with real estate and private credit, it's actually like your job is to get rid of the bad apples.
Yeah.
It's actually like to not do bad deals, but they're all good deals are the same. And in venture, it's the opposite, right? You're trying to.
Well, I assume in private credit, there's like a cap on what you can make anyway. So there's
right.
Okay, yeah.
So and with real estate, that's sort of true too. Like maybe you can make a 20% IRR, right? On your best deals, it's like 20s. So because of the nature of the risk profile, right? It's the exercise is to eliminate,
just not do the bad stuff,
not make mistakes, and so the venture is completely different, right? The opposite.
Yeah, interesting. What there's this publicly traded company, Destiny Tech 100, and they hold all these private company assets, or at least options for private company assets like Stripe, and they trade at a very significant premium, maybe even a 4x premium or something like that to the underlying assets. Like, what the heck is going on there?
Yeah, it's so funny because everything that's happened has happened before. So if you remember ICC, Internet Corporation, it was like a publicly traded. It was exactly like this. It was the third biggest tech company in 1999 on the stock exchange after Yahoo and AOL, and it blew up. So that's one of the challenges with trying to democratize private markets is that
you get like these bubbles and stuff for it.
That's the problem with all investing, but is that the if you try to actually have them trade on the stock market, they will never trade at NAV. They'll never trade at their fair value. They'll always trade at like sort of a premium or a discount. And if they're trading at a massive premium, right, it makes no sense. And if they're trading at a massive discount, then you can't issue new stock and you can't buy more things. You can't sort of do your business.
Yep.
And so you don't really see successful publicly traded private investment companies. It doesn't really work because the public market, I mean, you're seeing, right? The public, this is exactly what I'm saying about public REITs, right? It doesn't trade at what I'd say is fair value, true value. In this case, their Destiny is trading at like 169 million or something. And the underlying value of the stocks maybe 40 million. And so that's like extreme.
Yeah.
But it just shows you that like the stock market is like a voting machine, right? It's not like it's not as like the fundamentals matter maybe over like 5-10 years, but not in the short run. I think that makes it a challenge.
But in some ways, it does show that the public has this appetite to get into these big, well-known private companies. Obviously, they can go to Fundrise to go do that and get into OpenAI and stuff, but they have this big appetite to go do that, and they're, for whatever reason, they're willing to pay up, or they're just believe it's momentum play, and it's like the GameStopification maybe of some of these companies. I'm not totally sure why they're bidding it up so much.
Yeah, I am not a public market investor, and it's trades so far from fundamentals for me. I have a really hard time understanding like how things will price, and so that's why I'm glad I'm in the private markets. It's the only time you can sort of like buy the public markets is when it's like 2020, for example, when it just sort of collapsed. Like you can see these periods when it's really out of just out of sync with reality. Yeah. But then the rest of the time, you just might as well be an index investor.
Now, real estate is kind of famously an industry with, let's say, 1980s, maybe 1990s level of technology and data skills. Like, why is it? Why didn't they have moved faster on data and data science?
Yeah, because we have a lot of technology people here, and we've been working on trying to apply technology not just to opening up access, but to the investing part itself. And we've had a lot of iterations trying to figure out how would you build software that makes you a better investor. And the challenge is that most real estate investors invest infrequently. Like maybe a typical fund might only do like 3 to 5 deals a year. The transaction size might be 10 to 100 million. And so you don't really need software because you can afford to have enough people doing it by hand. So that's partly is just there hasn't been like enough reason for people to adopt the modern data stack. And then the other part is that there's the real estate industry and the technology it uses sort of matured together in the 90s. Like the real estate industry has been stuck in the 90s now for the last 30 years. And the major players that dominate real estate were all the major players that came out of the S&L crisis. So that's Blackstone and Starwood and these major public REITs because there were no public REITs before 1991, essentially. Like the public REIT industry is $1 trillion today. And in 1989, I think it was like 3 billion. Like it just didn't exist.
Yep.
And so the technology that serves those companies, which is CoStar, and those companies really came up together. It's you see this with like the Microsoft ecosystem of the 90s. Like it gets sort of stuck by the dominant kind of incumbents, and they only really lose their incumbency with some sort of like major disruption. And there really hasn't been a major disruption.
But that to me, it doesn't. That seems a little bit weird because there's so many. It's not like those guys are 50% of the market or something in terms of owners. So they might be the biggest, but there seems like there's so many players, there's so many little players, there's so many local players buying office buildings and other types of things. Like, wouldn't somebody really be innovating?
Well, I'm working on it.
Okay, yeah,
So
yeah.
Fundrise is working on
Or
building
is it just like the
a
people go
product.
into it, or the people like to touch the dirt and stuff, and if they're successful, the ones who can deal with like
No,
contractors and the
no,
plumber and
no,
stuff?
not at
Okay,
all. Not at all. I mean, it's Excel spreadsheets, it's CoStar, it's point and click kind of like data gathering. Nobody knows anything about software programming and real estate. I think we have more software engineers than probably any other real estate company in the country, maybe the world,
yep.
and not that many software engineers, right? So like Blackstone, I would say I would be willing to bet that us and Blackstone are of comparable technology capabilities, and that company has $1 trillion, right? I mean,
Yeah.
under management, they should have like a lot more technology capabilities, and they don't.
Yeah,
They're
in fact,
famous.
I know their head of data science, and he's only been there for a few years.
Yeah,
Yeah,
and like they don't
didn't even have
think
anybody
about
before
them
that.
as a venture investor, right? They almost don't exist as a. They're the largest private investor in the world, and they don't really have a footprint in the venture industry.
Yep.
That's like just like that gives you it's a metaphor for how far away the existing real estate industry is from technology.
Now, there are some tech companies in real estate. You know, there's VTS, there's CoStar, there's some of these other, like, what do you think of these like tech companies that serve the real estate world?
Yeah, I mean the problem is the real estate customer is a bad customer. Like the culture is defined by the industry. I mean, I don't know what the oil and gas industry is like, but I kind of imagine it's sort of like that. Like maybe before fracking, like fracking was this massive technology breakthrough. Um, and so, yeah, there are companies who have done some interesting things. And real estate, so the real estate industry has more innovation people realize, but it happens over like every decade, there's a new real estate asset class gets birthed. So if you go back, like way back, like 1960s, they birthed the mall.
Yeah.
And in the 1980s, they birthed these sort of like office buildings, downtown office buildings. All these things you look around and see them as normal. They got birthed every decade. And so, I lost my train of thought. Give me a second. The latest, the industry that was birthed in 2010s was single family rental. So that's invitation homes.
Yeah.
And they actually have a lot more technology. They're much more sophisticated. They actually have like a database.
Started in San Francisco too, so it kind of makes sense, some of these things. Yeah.
I think it's because they just have, I think 100,000 homes. You have to have software, but they actually have a database. Like they have probably on Snowflake, and so the industry, because the industry is old, like the software is old, and the new industry, single family rental, right? The software is newer, but like the office buildings or the apartment buildings, they more or less have been built and managed the same way for decades.
Now, Blackstone has kind of famously invested heavily in, let's say, warehouses maybe a decade ago. Like, what are the categories that are starting to bloom right now?
Data centers.
Okay.
So
I guess that would be the obvious one. Yeah.
Yeah.
Okay.
Yeah. I mean, like NVIDIA is a CapEx investment in data centers, right? NVIDIA is worth $2 trillion. So it's telling you that there's going to be this massive CapEx investment,
but you'll need more real estate, more data centers, or can you just replace the machines you have with like some of these NVIDIA boxes?
No, I mean, I think you're going to need a lot more.
Okay.
And it's a challenge because each one is really, they're vast. They're really expensive to build, like maybe a couple $100 million for just like one. And they draw a lot of power. Most people don't want them in their neighborhood. So they're really actually hard to get a location that has enough power that you can build it there. And so it's a little bit, I mean, what makes Blackstone such a good investor is they follow the major macro themes. And so like last few decades, it was e-commerce. That was what drove industrial. Now it's AI, and AI is going to drive, I think it's going to drive data centers, and I think it's going to end up driving residential work from home.
Now as you mentioned, these data centers need power. Is there some sort of like real estate play you can do for the power side?
I mean, it's the problem is that there's not a lot of excess power any location.
Yep.
And so to show up and put a major power demand in a neighborhood is going to drive up prices of power for all the residents who are the voters, and all power is set by a political board, power prices. And so it's a lot of the challenges of housing. It's famously hard to build in urban infill locations. Like it's data centers are going to really struggle with this dynamic. Like it's I don't think anybody has you'd want to have is edge compute, but no, that doesn't exist yet. And so it's going to be a big bottleneck for the industry.
Now, one other way to follow the trend is just kind of like where people are moving to. And I know that you guys have been focusing a lot on like the southern part of the United States. Is that just kind of like simple? That's where populations are growing, so we should be focused more there?
Yeah,
Is real estate that simple? Like,
yes, yeah. That's a real estate at its essence is a levered return on local GDP. So you'd say, okay,
yep.
Where do I want to invest in the world? United States. Where in the United States? Okay, the fastest growing states. Where in those states? The fastest growing cities. Which neighborhood? Which street? Like
yeah.
it's and so this is what like a little bit like with data centers or industrial. You have a levered return on a macro trend, and so like the top 7 fastest growing states are all in the Sun Belt. They added 1.3 million people legally 1.3 million people in the last 12 months. Okay, San Francisco added 10,000 people.
I'm surprised they added people. I thought for a while
I know.
it was
Actually,
declining.
I think it's because of the migrants. But it's but it's like that's a lot of people. 1.3 million people plus. Like that puts demands on real estate.
Now, there's been huge swings in like sentiment around office real estate. Like everyone was remote forever during the pandemic. Now, it looks like you and I are both now in an office from the video here. What's your kind of take on the future of office real estate?
I mean, I couldn't be more bearish because there's like two points. One, the parallel is e-commerce, right? So in 1999, e-commerce was 1% of the economy.
Yeah.
And retail was doing okay. But you're not competing against work from home today. You're competing against what work from home will look like a decade from now. A decade from now, I don't know what VR and AI is going to do to work from home and probably driverless.
So you think we're not at peak work from home? You think it's only going to increase over time?
Yes, I think there's going to be major technology breakthroughs. Like if the Vision Pro had really taken off, right? I mean, you'll see glasses at some point eventually create 3D meetings.
Yeah.
And so office has just got, I mean, it currently is bankrupt. I mean, currently the average value of an office building is the equity's wiped out, right? The average office building probably has a loan that's going to take a 50 to 75% haircut. And so that's where we are today. And I think that it gets worse both because of technology and because vicious cycles. Like if you go look at real estate or downtowns, and downtowns died or really what collapsed in starting 1968 with the 68 riots. And it didn't really recover until 1998. That's when like downtown started to come back. So 30 years of decline. And then they started to come back in the late 90s. And then they were sort of like rebirthed. So I think the decline of cities and office is going to be a decades-long story.
Well, if you think of like then that would mean that you would have fewer people, let's say in the suburbs. They would be moving to like the exurbs or something. They could get more land. They could be, maybe the schools are better or something. They could, change their lifestyle. Like, are we going to see these very weird real estate trends where like people are going to be moving accordingly?
I think that's more possible than a rebirth, like a return to office, even though it sounds crazy.
Yeah.
Because I mean, there's already like if you're Gen Z, you have much less, you're much more comfortable like spending less time with people. There's this sociological shift happening. It's kind of reminds me of like, not to get too out there, but like, Manuel Durkheim and like the birth of sociology. Like sociology as a field got birthed when all these people left their farms and went to cities, and that should have caused a sort of collapse of cultural norms and ennui and all these things. And there was this sort of this period of transition where obviously now we look back and like, well, nobody works on farms. And I think that you could see 50 years from now, like, well, nobody works in an office building. Like, and that sociological transformation could have huge effects on society.
And so if you think of like you and I both live in the DC area, and there still might be something about living like in a super urban place, especially if you're like young and hip and stuff. But then there's this ring around DC with all the suburbs. And then, but maybe like the best place to be is like west of Dulles Airport. You're still like, you're still, let's say 30 minutes to Dulles, or 45 minutes to Dulles. You can get to an airport really easily, a major airport. We can get anywhere in the world. Yet your land is very cheap. You've got good schools. You've got, other types of things. Like, is that something you think might happen, like more on the rise?
Yes. We're like not that far away from driverless, from VR, from AI. And these things sort of come together to create like, is your office actually a moving car? Like, what's the commute time at that point? Do you even care about commute?
Yeah.
Like there's these, I don't know when flying cars will show up. Is it 20 years? But like the like nature of a city, if you know that like how cities develop, like they're mostly developed around transit, subways, metros, major beltways, highways. Like it's you really have to understand how people move to understand how real estate develops and how to invest in it. And that's like, there's a great book called Edge Cities about that, which back then was like Edge Cities would have been like Tyson's Corner, which is at the intersection of multiple beltways. And the developer owner of Tyson's Corner like made sure those beltways like ended up there. It wasn't an accident. So like where your transit stop ends up creating a lot of value. So that's, I think something like that's why I said there's so much change underway because of technology, and the real estate industry, for whatever reason, has been completely behind the eight ball every single time. They just are like, they don't appreciate how much, the biggest value destroyer in real estate has been technology clearly with work from home, clearly with e-commerce. Destroyed trillions of value. And yet somehow they continue to ignore, like right now, it's got to be one of the most transformative periods in technological history. Like there's the potential of it being just insane. And real estate people are just like, it's like not really in their equation. It's bizarre.
Now, there's all this talk of like these banks owning a lot of this real estate assets, especially a lot of this office stuff as these loans come due and they get repriced. Like, what is going to happen in that world?
So the office industry is about $3 trillion of real estate. And so how much is that office worth now? Like it's hard to say, 500 billion, something like a huge, so you're talking about
what you think goes from 3 trillion to 500 billion?
A trillion? Something like that, right?
Wow.
And so
that's that's a destruction of value way more than the housing crisis was in 2008.
Yes, way more than subprime mortgage crisis. Is actual destruction of value. A lot of the subprime mortgage crisis was
just people couldn't afford it.
Paper losses, but ended up being, you saw a recovery in value after probably by 2013, like most of the paper losses were gone. Like famously, all the TARP bailout, nobody lost any money. Fannie, Freddie, like it's actually been kind of a very surprising if you were there in 2008. But this time, I think office, just like malls, like they're not going to the destruction of 2/3 of the malls in America, like that those are gone. They're not coming back. And that's going to happen with office. But office is more challenging than a mall. Like a mall is a kind of a singular asset. Like if you have a really big fancy mall, Short Hills Mall, or I don't know if you're, Tyson's Corner 2, famous malls, like office is a commodity. There are like 100 office buildings nearby that are really comparable. And if like, let's say 10 of them go sell for 10 cents on the dollar, they're going to lower their rents by 90%.
Yeah.
And pull every other office down.
Yep. Interesting. Well, right now, like we're seeing interest rates above 5%. Inflation is, let's say 3.5%. Unemployment's below 4%. A lot of people were predicting a recession that hasn't materialized. Like, what is happening in the economy overall?
Yeah, I was predicting one, and I still am predicting one.
I predicted 15 of the last 9 recessions, right?
I mean, I maybe I have PTSD from 2008, where I just watched what happened with here's my narrative of 2008. Financial institutions abuse basically trust and are reckless and take on too much risk, and then eventually that risk comes, you have to pay that risk, and they blow up. Like that's what happened in 2008. That's what happened in the 80s with the S&L crisis. Like that's kind of the nature of the financial institutions. So like, why would their nature didn't change? So like the question, and we went from a ZIRP environment, right? We were at zero interest rates effectively for more than a decade.
Yeah.
And so everyone normalized ZIRP, and now we were at higher for longer. And so that implicit shift, I mean, right remember these articles in 2021 when there was like $15 trillion of negative interest rate bonds in the world?
Yeah.
Like there's something not adding up to me, because there's enough losses from office, from the long dated maturities, and I look at the amount of debts in America. I don't believe that our economy can support the interest rates we have, even though they have so far. And I believe I'm not totally old enough to like be sure of this, but I'm pretty sure from when I look back, there's always this period like 2007 when it looked like there wasn't going to be a recession. There wasn't, it'd be okay.
Yep.
And it just never plays out that way. Like they raised interest rates from 1% to 5% from 2003 to 2005. So similar kind of movement. And it was in 2005, 2008. It took 3 years of high interest rates for it to finally blow up. And then it blew up like, massively. So there's just something like really like, kind of like, to me, like visceral about the natural cycles of highs and lows. And the high was so high, the low I don't know how you, like what angels exist that we would, but it's, it's very, I mean, AI could basically, I always thought, I've said this to my friends for a decade, that there always was a race between debts and AI, and which we could get there faster, because, American debts are like, it's a classic problem of empire. And so AI might get there first. Like it's here, it's starting to like hit productivity. And so it's possible we get out of it, but that's like, I don't know, it's like hope triumphing over experience. That's not my experience.
There's also this talk about like the housing shortage that a lot of people talk about, these several million units that are short. Can you break that figure a bit, like that, break it down? Like, is it, I assume in certain places there's a housing surplus, certain places a housing shortage, depending on the population growth and, or what's going on there?
Yeah. I was sitting with a reporter who was telling me they was going to write a book about this. And I was like, well, what are the base effects, right? Because, the whole base effects is like the thing people seem to miss. So from when I applied to college to today, there are 75 million more Americans. Okay. In that time period, how many houses or housing units did we build?
20?
30.
30. Okay.
Right? So what what are those extra 40 million people doing to housing
Well,
prices?
I assume you have many people per house, so maybe that you
No,
usually have
housing.
like 3 people per house or something,
No,
or
it's. I mean, it's the point is it drove up housing prices, right? That it is like the fundamental thing that drove up housing prices was that the population increased by a huge amount, and the number of housing units that got built were way less. And so
sorry, how much should there be per person in like if you have 100 people in population, how many housing units should there be?
there's no should, because as you get wealthier, you actually consume more space.
Yeah.
And so the country got wealthier, so actually we consumed more space. And so actually, like,
some might be second homes or something, or
yeah,
whatever.
or just bigger home. Like, I mean, like,
Yeah.
the number of people used to live in an apartment in, New York, Lower East Side compared to now. I mean, it's radically different. So
But to me, like 30 million housing units for 75 million people sounds like plenty. Sounds like enough for because you have multiple people per unit.
No, I don't think it is. I mean, I think that's the fundamental reason why prices have gone up so much.
Okay, interesting.
Is that like, one unit per person is like, was not enough. That's why you get these stats around, like, whatever. There's 10 million how some large number of housing units that are missing from the market.
In the U.S., there's like roughly 310 million people, and there's probably like 180 million units or something like that. So like there's like some ratio that exists, and I assume it's always been like way less than the number of people.
Yeah, it's there's so many. It's all things are multiply determined, and so there's so many drivers to this. But like wealth drives more housing consumption, and then density. I mean, what America also, right? If you go back, I mean, America was not dense. Like,
Yeah.
Europe was dense, America was not dense. And now, and even like in my lifetime, if you went to cities like Denver or Portland, it just wasn't that dense. And these cities have filled in, and it's much harder to build more housing in a dense location than a greenfield.
Yep.
And the greenfields generally are more than 45 minutes away, and so the consumer doesn't want to drive more than 45 minutes to the
unless they work from home.
Well, this is a transformation.
Yeah.
But we're talking about, like, that's only the last 24 months or so. And so, like, all of this is downstream of the technology that is called the automobile. And the automobile created space for housing, from like the 1930s to now. And then, like, we hit a point where, like, the density and the distance stopped working. And that's, happened around the 2000s. And so you have like these multiple dimensions. You have like population growth, you have density, you have incomes, and you've ended up with this problem. But the problem is, like, yeah, if you end up with this scenario you and I were just talking about, which is a little bit out there, that we just see tons of housing construction in the, basically where there's greenfield and you have driverless cars and remote work that mediates the difference, then I think you'll see housing prices like stabilize.
And we've seen like the home ownership percentage in America has been relatively steady. And there's this increasing number of institutional investors that are moving into residential real estate, especially in these kind of like built to rent type of scenarios, like you mentioned earlier. Do you think like we'll see the home ownership percentage decline, or where do you think that's going?
I mean, mostly that's a rounding error, but there's like the industry got built on all the foreclosures that happened last decade, and that's single family rental. And that's a little bit of a zero sum game, or it's totally a zero sum game, right? Like either a person lives in the house or an institution owns it and rents it.
Yep.
And I think that politically is going to become extremely challenging. So the industry then invented a new concept called build for rent. Well, they'll build housings for rent. And I think that's much more politically viable, but it runs into similar challenges as all construction, which is that it's expensive. There's not that many locations, and so you really have to like we went and built thousands of these built for rent communities, thousands of units, and we found like a varied experience with like location and city. And it's challenging. I mean, if I think of real estate as a consumer product, not just an investment product. People consume a house, they buy it because they want to live there. It's the most expensive consumer product they'll ever purchase.
Yeah.
Same thing with like when you go to a restaurant, right? You go there because you're consuming, and even though you don't really see that as like I'm consuming real estate, but it has like design, and that's a huge factor in how you price something in real estate. And so, delivering a consumer product that is affordable and has like the light and the air and the backyard and all the things people want in a location they want is challenging, super challenging.
Now, what are there are some of these like very ambitious development projects, like the California Forever project and stuff? Like, how do you think those things are going? And do you think we'll see more of these?
Yeah, there's been you've seen over history, like these big money will go out and try to build a city or build something. And it kind of reminds me of what happened in the venture industry, where they thought if they threw money, SoftBank Vision Fund, sort of, if they had enough money, they would create demand. And that obviously didn't work, right?
Yeah. Well, I kind of work with Uber and Lyft in a way. Like we all use them because of it, right?
Yeah, but
or DoorDash
would it have made any? Would you think that if Vision Fund hadn't, or whatever the Saudi investment corporation hadn't written those checks, that we wouldn't be using Uber?
I think so, because I think they had to subsidize consumers and drivers for a very long time to actually get it to a point that we'd be willing to pay a higher price. And so I think it's true with DoorDash as well. Like they'd have to lose. I feel like those businesses almost had to lose billions of dollars to make them work.
Interesting. I see those businesses as like, I mean, maybe we would have been better off if their taxis hadn't been eliminated and they were both, because now the price of Uber is like kind of crazy. And so the
still cheaper than a taxi.
No way. No way.
Oh, no? Oh, okay.
No, I mean, a taxi in my experience is a third of the price of Uber these days.
Oh my gosh. Wow.
And the last time you took a taxi,
check my app. Yeah,
you gotta take a taxi.
Yeah.
But I don't think
I take a Lyft or Uber every single day. Oh yeah. I feel like the prices are pretty reasonable.
Okay, well, you're at the top end of the market, I'm going to say.
Okay, that's fair.
But yeah, like
not a black one. I don't take a black. I'm taking UberX.
Yeah. Me too. Too. So yeah, it's I mean, I know about the California Forever project. I could get into like kind of mistakes they made around water and the military base, and how kind of like the person who's leading it wasn't a real estate person. They were a person from Goldman, and they just made a lot of mistakes that kind of like were, I don't know. Just like, I guess you make mistakes when you start to do something new. But in general, those types of like, there's been a lot of people who've tried to build cities, like a lot of times a lot of architects, and it's not usually it's not a good economic investment. Like it may end up eventually
maybe a cool thing.
Yeah,
like isn't where near where we live, Reston, Virginia was started as like a planned city, right? I don't know if it was ever a good economic investment, but they built something pretty cool.
Yeah, like and Mobile actually owned it, and then Canary Wharf was a city that was built, and then it kind of went bankrupt, and then went bankrupt again.
Yeah,
so, a lot of times these things, like these great places, like eventually, maybe in the course of decades, they could, but it's like, it's not an economic endeavor. It's like it's an ego. It's driven by ego, and which is usually not a great investment.
Yeah, interesting. What do you think of these, like all these like idea of these prefab like houses or pieces of houses, and like, or do you think these are like, to me it seems like intuitively it makes sense, like manufacture all the stuff in like one area and then move, rather than manufacture it all on site, which is how they build most of these things today. But it hasn't really taken off. Like, where is that going?
Yeah, I mean, it does. It makes sense in theory, but not in practice. So I've tried to build them. We looked at buying a manufacturing plant, and it's one of those things where the home builders like Lennar, they're actually a giant factory, and they
just move the factory to the location.
You don't see them as a factory, but they operate just like a factory without walls.
Yeah.
And they deliver homes at like unbelievably low cost. I mean, $135 a square foot, $150 a square foot. And it's actually really difficult. I mean, when we looked at what like a manufacturing of a house would be, it's like $200 a square foot.
Wow.
And then you have a lot of complexity on the site. You ultimately still need people on the site to assemble it.
Yep.
And then there's a lot
to
of
like bring the water and the power and all this,
and
kind of like move it and just
literally
put the Legos together. Yeah, totally.
Because the Lego blocks have to move down highways, and the highways, so that it sort of limits the size of the block.
And you get there and you realize, it doesn't fit perfectly, and then you have to do some sort of divot thing or something.
It's more just that ultimately you're going to need people on the site doing the assembly. You're going to have, and there's a lot of the code is actually challenging. They should be able to just approve it in the factory, but they actually, because all the code's local, they mostly you have to have them approve it on site. So there's just ends up being one of those things where it would have to be like $50 a square foot or something for it to like disrupt the industry. And unless materials, like I don't see how that's possible.
And I didn't know that. So the average home you said is about 125 a square foot or something
to build it.
To build it. Obviously, the land is expensive and all these other things.
150 a square foot. I mean, no, I think that includes.
That seems like very reasonable.
Yeah. So I mean, actually, I'm thinking about that. Might include the land.
So 2,000 square foot home costs, $300,000 a bale type of thing, or
less. I mean, these guys have huge margins right now. They have like 30% margins, and so it's actually like the input costs of like is not that much. It's not the main problem.
Yeah. Interesting. Now you and I are both in DC, and I love talking to DC entrepreneurs. You're one of the more successful entrepreneurs in DC. Like, how do you think about the DC tech scene?
I was like in it when Fundrise was like a small company, and it was a really kind of vibrant DC tech scene in like 2016 or something, 17. Ever since COVID, I've just like been disconnected. Like I'm not like the last time I hung out with somebody, I think was with you. So I don't know. I just have kids and I read and, work. So I'm not, I feel like DC, the challenge with DC is that it's a government town. That's good. But like that,
there's a lot of like cybersecurity companies, a lot of government tech companies and stuff like that.
Right.
And like your company, in some ways, there's no reason why you're in DC. You could be anywhere.
Yeah. Yeah. And I looked at moving out of DC. It's just like, once we had work from home, it didn't make a difference where we were. So,
and you're from the area, right? So it made sense.
Yeah, I'm from DC, and originally we started here because I had real estate. We were building real estate, and I wanted to democratize investing in it, and I went to the SEC and I said I want to democratize investing in this, and the SEC was like, "That's so silly and crazy." This is like 2011. And they just thought that was the cutest thing, and so they were like, "Sure, like go for it." That's the funny thing about a lot of the government is that if you just walk in the door, it's just people, and they actually usually intend well.
Yep.
And you can usually get what you want. It's just going to take time. Like it's going to be slow as all get out, but it's all doable.
Now, a couple last questions that we ask all of our guests. What is a conspiracy theory that you believe?
So I don't think people appreciate how fragile the civilian control over the military is. It's people see it as a given, but it's really a cultural norm. There's actually nothing in the Constitution that puts the military underneath civilian control. And you've seen.
I thought the president was the commander in chief.
Yeah, but like if you look at like the one of the first kind of constitutional crises around this was when Truman fired MacArthur.
Yeah.
And MacArthur came back to the United States and essentially tried to overthrow the president. Like it wasn't. The largest ticker tape parade in history was for MacArthur after he was fired by Truman for wanting to drop nuclear bombs on China.
Yeah.
Like Truman's ratings were the lowest in history. They're 23%, look lower than Nixon during the Watergate. Like there was a possibility, right, that MacArthur. I mean, it just,
Yeah.
and if you
People
go
said
back,
if he had marched to the White House, people would have followed him, maybe.
Yeah. So then and I think you look at like Kennedy, Nixon, Johnson.
By the way, in my opinion, MacArthur is the most overrated general. Like he had a couple of smart things, but he had basically mostly just strings of like over calculations and losses and stuff.
Yeah. And his ego, like, it was just poisonous. I mean, it's like, totally agree. But my point is that like, there's been actually like, not rising to that level of constitutional crisis, but under Petraeus, it happened. You know, Obama fired Crystal.
McChrystal.
You saw it. You saw it in the in Georgia. You know, Cheney fires another general. Like, there's this long history of this like tension between the civilian and the military. And I'm not saying, obviously, I'm a huge supporter of the military, a deep believer. But my point is that like, it's not impossible for me to believe that there's been times when people in the military have sat around the table looking at the president, looking at Nixon, looking at Johnson, looking at Obama, thinking like, this guy has to go. And January 6th, like, could have gone I'm not trying to be political, but it just could have gone a different way with different people in different seats. And so I just think that people take it for granted. If you look at other countries, like, that's normally the source of coup d'etat, source of like real instability is the military.
Or in some cases, it's the source of stability, depending on the way you think about it. Like, it's the source
when they take
of,
over
like,
the government,
or they keep some sort of continuity, or they stop a dictator. In some cases, so you've seen some of those things. Like, it's not clear to me Pakistan would be better or worse if it wasn't like run by the military, or would Egypt be better or worse if it wasn't run by the military?
It's just like we think it couldn't happen here.
Yeah.
And I think it absolutely could. And it's only because of the people, like the Joint Chiefs, like have like deep commitment to democracy. Yep. But that doesn't, anything can happen. And I just think that's something that like is totally underestimated by most people.
Interesting. All right. Last question we ask all of our guests: what conventional wisdom or advice do you think is generally bad advice?
Follow your bliss.
Follow your bliss.
Yeah, the whole follow your passion.
Yeah.
Like, my experience is that success and fulfillment is a path of suffering.
Mm-hmm.
And like, I think what people mean by following your passion is that like you're willing to suffer more because you enjoy it.
Yeah.
Not because it's supposed to be fun. And I think there's this misunderstanding about.
We should all run out and become interior decorators or something. Or
well, there's this idea, like, I feel like that there's this idea that like it's supposed to be easy.
Yeah.
And it's like, it's not fair if it's absolutely like brutal and miserable. But I'm like, no, like the path to enlightenment is through suffering. Like, that's suffering is the key to success. And you don't see people preaching suffering to students in school. Like, they preach kind of idealism.
Yeah.
And I don't think it's actually serving anybody.
Interesting. Okay. That is, I would say, the most common answer to this question is yours. Why do it seems like a lot of people agree with you that this is the worst conventional wisdom.
Is it because you mostly have people who've been through kind of a similar experience as mine, where you're like, like, my health fell apart. Like, I had I wasn't sleeping for years. I felt like I was near death.
Oh my gosh! Wow. Okay.
I feel like my experience was like there's a loss of innocence, and it just didn't seem like conventional wisdom was all right about the keys to progress. And so maybe that's just a common like discovery for people who go on to try to do something hard, is that like it's misery and suffering. And then once you accept it, rather than like I fought it, I sort of like didn't, as a man, I thought like, well, this is not really like, my job is not to like complain. And I think it got a lot worse because I wouldn't accept and see what was happening.
So then you just started complaining and it all got better, or?
No, I had to hit rock bottom before. But it's I think stoicism is like I feel you get there eventually, but it's not taught anymore.
Yeah, that's a good point. All right, well, thank you, Ben Miller, for CEO of Fundrise, for joining us, Roll of Dice. I follow you at Ben Millerize on Twitter, or X, or whatever we call it now. I definitely encourage our listeners to engage with you there. This has been a ton of fun.
Yeah, thanks, Auren.
And if you're a super data nerd, go to worldofdas.com. That's DAAS, worldofdas.com, and sign up for our weekly Data as a Service news roundup newsletter.
Thanks for listening. If you enjoyed the show, consider rating this podcast and leaving a review. For more World of DAS, and DAS is DAAS, you can subscribe on Spotify or Apple Podcasts or anywhere you get your podcasts. And also check out YouTube for videos. You can find me at Twitter at Auren, that's AUREN, Auren, and we'd love to hear from you.